Welcome to the Simply Safe Dividends channel. I'm your host, Brian Bollinger, and in today's video, we're talking about YieldMax ETFs. I'll be honest, I don't really want to talk about these funds because I think they are one of the bigger marketing gimmicks that I've seen in recent years, so I hate to really shine more light on them than they deserve. But with them offering headline yields of 50%, 60%, 100% or higher, I know a lot of income investors out there who have seen these trendy products are kind of wondering, is this a cheat code for passive income, or are these funds a potential ticking time bomb for my portfolio? I'm obviously a little negative towards these funds, but in today's video, I'm going to break down all of the research I've done into these funds' strategies, performance, holdings, and help you really understand what these things are so you can decide for yourself whether or not there's something you want to be involved with. So let's start with what these YieldMax ETFs are, how they work, and then I'll kind of get into the good, the bad, and the ugly. I pulled up YieldMax's website, and your spidey sense should already be tingling a little bit as you see this carousel of familiar company logos that are plastered next to these sky-high dividend yields with no other information about the strategy's performance, risks. In total, YieldMax has over 40 ETFs today. They've all been launched in the last few years. In this video, we're going to be focusing on what are known as covered call ETFs, which is the most popular lineup of products offered by YieldMax anyway. Now, what is a covered call? It's a strategy where investors look to make some income from stocks that they hold. So I'll show you a quick example here on Schwab's website using Tesla as an example. Suppose we own shares of Tesla, which trades at about $283 right now, and we wanted to make some income on our position. We could sell a call option, which is basically a promise to sell our stock at a certain price within a certain amount of time. And in exchange for that, we get paid a fee, a premium, right away for selling that option. So I'm going to pull up the call options that are available on Tesla here. And you can see there's different expiration dates 1 week out. Tomorrow, Friday, and then we also have 8 days, 15 days, goes on and on down the chain. Suppose we wanted to just part ways with Tesla if it moved higher than its current price at 282. We could look at an option that's, say, 29 days away, that has a strike price of $280. That means if Tesla goes above this price, then the buyer of the option can buy those shares back from us at $280, even if Tesla is at $350. They get all that upside. In exchange, we get a premium, a fee today of about $22 for each Tesla share for giving up that future upside. Now that works out to a pretty juicy yield north of 5%, generated within a 30-day period. So if you were to do this strategy throughout the year, that's how you get up to those crazy high yields you're seeing on YieldMax's website, 50% plus, just from selling these call options. But you're probably wondering, well, what's the catch? A lot of investors like call options, this covered call strategy, because they feel like they can't lose money. But that's not really true. There's a big opportunity cost, which is really no different. So this strategy, the way you get burned with selling covered calls is when the stock that you hold shoots much higher to the upside during the period covered by your option, and the shares get called away. You miss out on all those gains. So from Global X here, they're giving an example where you bought a stock at $50 a share and you wrote a call option with a strike price of $50 a share. You received a $2 premium, which is good for 4%, for selling that option. So if the stock goes way above the $52, again, your $50 price plus the $2 in option premium, you miss out on all those gains. The buyer of the option captures all of that value. The strategy outperforms if the stock price here in orange kind of stagnates a little bit. You still have all of your shares, the option wasn't exercised, and you kept that premium. And same thing if the stock in orange here declines by a lot, you are exposed to that entire downside. However, you have a little bit of premium income from the option, which helps you slightly outperform when stocks fall. You're keeping all of those shares. So in a nutshell, a covered call strategy, you missed out on the upside. You get some current income today for giving up that potential, and it does best when stocks kind of stagnate or decline. So a lot of people like to write covered calls if they hold a stock that they think is potentially overvalued or they're willing to kind of part ways with near its current price, or at a certain strike price that they're willing to sell an option at in the future. Now, covered call strategies have been around quite a long time. there's this buy right index that's been around since 1986 that tracks this covered call strategy applied to the S&P 500. So it owns all the S&P 500 stocks, and it writes or sells call options on these stocks. I think they expire within a month, and they're sold at strike prices equal to the current price. And taking a quick look at the calendar year returns here, it's kind of what you would expect. When the market has a really strong year, like in 2013, it was up 32%. This strategy was only up 13% because stocks moved a lot higher faster than was priced into the options. And on the flip side, in 2022, when the S&P 500 was down 18%, this strategy was only down 11%. Now, if you zoom out and look at all the way back to 1986, covering almost a 40-year period there, the annualized total return of this strategy, which is going to reinvest all the dividends, has been about 8.5% versus 11% for the S&P 500. So you've had a somewhat lower total return, but the volatility has also been a lot less. The biggest drawdown you would have experienced was a 36% loss compared to 51% for the S&P 500. But there's really no free lunch. At the end of the day, the Sharpe ratio, which is just a measure of risk-adjusted returns, has been identical between this covered call strategy and the S&P 500. It just kind of depends on what type of investor are you. Are you trying to optimize for long-term returns and growth, or are you more concerned with current income, a little less volatility? Those are some of the big questions to ask yourself when evaluating these covered call strategies. Now, when you look at some of the vanilla covered call ETFs like JEPI, that yields about 7% today. QYLD is the NASDAQ 100 covered call ETF. That yields a little more, about 11%. But none of that is close, right, to these ETFs that are offered by YieldMax. Not even close. So how does YieldMax do this? Well, a few years ago, the first single stock ETF launched. Now, I'm not a big fan of this at all. I think the SEC might even look to crack down on this a little bit, because when an investor thinks of an ETF, they think of something that's diversified, generally kind of safe. But these single stock ETFs are obviously very concentrated. They're exposed to just one underlying security like Tesla. And that allows YieldMax to write these options like we saw with our Schwab example here with Tesla that generate tons and tons of options premium income compared to something like the S&P 500. One way to think about this is an option is kind of like car insurance with how it gets priced. If you're in a dangerous area where there's risk of break-ins and the roads are in bad shape and there's a higher rate of accidents, you're going to pay more for car insurance than you would if you're in an area where it's always good weather, it's very safe, you have a good track record. And options pricing is kind of the same. If a stock has a wide range of outcomes, it's volatile, the options are going to be priced higher to account for that potential for fluctuations up and down. So right here, we're looking at a chart that shows the implied volatility in these options for Tesla. And you can see it ranges from like 40% to 75% throughout the last year. So this is generating a really big yield to sell call options on Tesla. The broader market, if we look up SPY, the S&P 500, the implied volatility for the broader market has been closer to 10%. So if you're paying out all the options premium, if you have a diversified fund like this as a covered call ETF, you really can't pay out more than 10% would be fairly aggressive to kind of match the typical options premium. But when you go to the single stock world, you can get these just massive payouts because the stocks are so volatile. And that's what YieldMax is really capitalizing on with their funds. But the big question is their strategy a good one? How has it held up over time? And that's what we'll look at next. I'm going to take a close look at TSLY, which is YieldMax's Tesla Option Income Strategy ETF that sports a 78% advertised distribution rate. I want to look at this fund because it's one of the oldest YieldMax products. It was launched in November of 2022. So we have a slightly longer track record to work with here. And somehow this product, it astounds me, has amassed $1 billion in assets, certainly chasing that headline yield. Now, I put together a few charts that'll help us really understand this product and why I view it as kind of a gimmick more than anything else. This first chart assumes you had $10,000 that you put into straight up Tesla shares in orange and $10,000 you put into the YieldMax TSLY ETF back when it launched in November of 2022. I'm assuming that you bought the fund for the dividends and you took them all as cash and spent them, whatever you wanted to do with them. You didn't reinvest them. Well, that would have been great initially. Your account now has fallen 75% down to $2,500, while shares of Tesla, if you had just put the 10 grand in Tesla, are worth $16,500, but didn't have the fun, eye-popping dividends along the way. Now, the YieldMax advertising, that distribution rate, I think it's pretty misleading. That's being generated, again, as we saw, from the option premiums from selling calls, but you can't really think of that as income. Those options are sold, and the premium you get is to protect you from the downside. You're giving up the upside in Tesla, right, by selling a call option, but you're also getting compensated for whenever Tesla also falls and goes the other way. And if you're just doling out all of those premiums as dividends for your fund, you're handcuffed on the upside, but exposed to all of the downside. So whenever Tesla goes down and you're just dishing out the call option premium to investors, you're just going to kind of lock in these losses in Tesla stock and never really be able to recover. So that's why you see this long-term erosion in the fund's price. It's because they're giving out all the options income, but they actually need to be keeping onto that to protect the fund from when Tesla goes down, so they can kind of participate more in the recovery. Now, the falling net asset value of the fund, which is basically that price we just looked at here, and is shown again this time in orange, it causes problems for the dividend as well, because when the fund's assets fall, it has less money to run its options strategy, right? So that results in falling dividends as well, which are shown by this blue line. That's the TSLY dividend per share. So if you first bought this fund back when it launched, you'd be really excited. You see this 60% yield. You're getting some sort of mysterious exposure to Tesla. But a few years later, you've hopefully sobered up a little bit and seen not only the value of your investment fall 75%, but the dividends along the way have been more than cut in half. If you think of it from a yield on cost perspective, you're initially getting a 60% yield, but on that initial 10 grand, now your dividend is down to, below $1 a share per quarter. Your yield on cost has fallen from 60% to closer to 20% today. And that's only going to continue as long as YieldMax maintains this really aggressive distribution policy and kind of advertises it as being income when it's really capital that the fund needs to hold on to more of, or it's going to face this type of chart. Well, what if you said, okay, I'm going to forego the dividends. I'm going to reinvest all of them back into TSLY. Not so fun. You don't get any of the big yield to enjoy, right? But even if you're doing that, which this chart is showing you, so this is the total return with all of the big dividends reinvested, you're still coming out behind. Now, the strategy itself is kind of performing as you would expect if you look really closely. TSLY is in blue, so when you can see Tesla goes down big in orange, you can see TSLY didn't go down quite as far. That's kind of the benefit of a covered call strategy. But then when Tesla rips higher, TSLY doesn't keep up. And unlike a broad market covered call strategy like JEPI that we looked at, when Tesla rips higher, it can rip higher in a hurry. Like if you look at the fall of 2024, this move in Tesla's stock was just unbelievable, and the options premium did not compensate nearly enough for giving up that type of upside. It created a huge performance gap with TSLY. So I think when you're looking at the single stock covered call strategy like this, where you're just repeatedly writing these call options, I think it's very difficult to kind of keep the risk-adjusted performance even similar to what the underlying stock is doing, because you can just have your face ripped off at any given time. And that's not even to mention the crazy high fees that YieldMax charges across its lineup of ETFs. Again, you usually think about ETFs as being these like low-cost diversified vehicles, but at least to YieldMax's credit, they do show that on this table. Most of its funds have about a 1% expense ratio, which is very high for an ETF. The fund of funds it has, which is YMAX, pretty popular because it pays dividends weekly, that has a 1.3% expense ratio. So that's eating right into your returns from these funds, not to mention just the cost of running these strategies. I mean, you're turning over so much of the portfolio to be buying more options every month or even faster than that. So it's kind of a high cost strategy to execute. You're dealing with distributions that are advertised as income, but they're really destroying your capital because you need to hold on to some of those premiums to offset the times when Tesla drops. That's what you're kind of getting paid for. But YieldMax is not doing that. They're giving all of the income out to kind of give you that sizzly headline yield they can advertise on their site and rake in billions of dollars across their lineup of ETFs. When I think about these YieldMax funds, an old Warren Buffett quote comes to mind where he said something like, "Time is the friend of a wonderful business, but the enemy of a lousy business." And I really feel like these YieldMax funds are kind of in a race against the clock. You can see that the guy who is the sub-advisor to these funds has been pretty active doing interviews on YouTube, including with a lot of small channels kind of like mine. And they're kind of capitalizing also on this big appetite for big tech, right? The Magnificent Seven have led the market higher. There's a lot of interest in AI. So they're kind of packaging up that investor desire with these super high advertised yields to create this perfect storm of interest that just sells really well. I feel like these guys are really good at marketing, but that's kind of where it stops. And I think that there's some pretty meaningful and building sources of pressure that could really change how these YieldMax funds have to operate over the next few years. You can kind of see some of those cracks forming right now, actually. So as we looked at, a lot of these funds have seen their net asset value just decline because the payouts are clearly unsustainably large. And that's resulted in some of these fund prices getting so low that YieldMax has had to come in to do what's called a reverse split, where they basically give you half as many shares as you currently have, but at twice the price. And they do that because if you look at a fund that's offering a 70% yield and trades for $3 a share, you're like, this seems kind of sketchy. But if they can do a reverse split to get the price higher to something that feels more comfortable and normal, you're more likely to buy it. So they're doing that. They've also recently changed how they can manage the portfolio's returns. So they've now given themselves, since these are actively managed funds, I saw that they recently allowed themselves to take more risk, essentially, when a stock is down. Instead of just selling a call option, which is going to cap the recovery, they can now do some sort of other like credit spread option strategy. I'm not super familiar with what it is, but the idea is that they can kind of capture more of that upside gain. But I'm pretty skeptical that anyone can predict what something like Tesla is going to do any given month. So to me, that kind of feels like a risky kind of desperation move to, again, try and stop the bleeding in net asset value. Now, I think people will also increasingly wake up to the falling dividends over time, the falling price of the fund you bought over time, and start to really question, like, what is this thing that I own? Because this doesn't look very healthy with what's going on, which is a completely fair question to have. I think at the end of the day, YieldMax would be best off if they slashed their distribution rates probably by 80% or even more for some of these, just to get to a more sustainable level where they can kind of keep their asset value stable over time. And the reason why they haven't done that is because it doesn't sell, right? You can't market an 80% yield on Tesla if you're cutting that yield by 80%. So that's probably the last thing they want to do, but it's probably the first thing they should do. I also think the SEC should really be looking more into these single stock ETFs with how they're presented to retail investors. Yes, technically, an investor could go open up the prospectus, read through the filings, do some of the analysis I shared with you today. But in reality, we know a lot of investors are not going to do that. They're just going to see, hey, this thing has a great yield and it's an ETF, which kind of gives them this false perception of diversification and kind of a set it and forget it investment, which these things are definitely not. So I'm really not a fan of YieldMax funds. I think that they are truly the example of a yield trap that you have to pay a lot for with expense ratios and just the cost to implement the strategy. I think conservative investors should stay away from these things, even if you're like, well, I just want to put in 5, 10, 15% of my portfolio to get some extra yield. It's a bad idea. You're going to be much, much better off over the long run if you stick to a quality dividend growth portfolio. And if you want to enhance the yield of that, then periodically sell off some shares when you have the opportunity to do so, when it's a wise time, or write some of your own call options if you want to do that. Those are going to be ways that you can get more return over the long run from your portfolio while also having just a great sense for the safety of your income stream. And at Simply Safe Dividends, I've spent my last 10 years working on this business full time. We provide everything you would need to do that. We provide a dividend portfolio tracker that makes it really easy to stay between the guardrails. We have dividend safety scores backed by a real-time public track record to help you avoid dividend cuts before they happen. We publish research on dividend stocks and closed-end funds. There's a screener, stock pages, everything you really need to carry out this passive income strategy safely, responsibly, and really feel like you know what you're doing without all of the nonsense that's out there. So if you want to check it out, it's totally free to try. We have a 2-week trial, no credit card required or anything like that. I'll leave a link in the description below. Otherwise, it would also really help me out if you enjoyed this video, if you wouldn't mind hitting the like button or subscribing to our channel. I try and publish around 3 or 4 videos a month. Again, they're all pretty objective takes on dividend investing topics, stock analysis, could be looking at YieldMax funds, things like this that kind of help you get a sense for what really matters and none of the yield chasing and gimmicks that are unfortunately out there. So thank you again for watching, and I hope to catch you next time.